Hey, what's up, stock compounders? Brad here. So today I watched a Li Lu lecture from 2012 at San Francisco State University. It's been on my list for quite a while now. I finally sat down and watched it. It was only 35 minutes long. I'm going to link to the video in the description if you want to check that out. But, one of the best ways, perhaps the best way, one of the best ways to become a better investor is to learn from the great investors, to learn from the greatest investors that we have access to. And I consider Li Lu definitely up there among the greats. And his lectures are just so packed with nuggets of wisdom. So, I wanted to share my highlights from this Li Lu lecture from 2012. So, he starts things off by saying there's three basic ideas of value investing. The first is a stock is not a piece of paper to be traded, but a fractional ownership of a company. And that's really something that Benjamin Graham and Warren Buffett preach as well. Valuing a stock requires that you value the company as a whole, right? This is taking the perspective of being an owner of the business and not just trading a piece of paper. The second basic idea, valuing any financial asset involves predicting the future, right? The discounted cash flow of future cash earnings, that's really what we base what the value of an asset is. What is it going to produce in the future? And what is the appropriate rate to discount those future cash flows back to the present? And of course, the future is inherently difficult to predict, right? So you really want to leave yourself a margin of safety. When Benjamin Graham was asked to summarize in 3 words, sound investing, his 3 words were margin of safety. We need to be buying at a significant discount from what the shares are actually worth. Even if all adverse events occurred, you'll still be in the game. That's the idea with the margin of safety. If you buy with a steep enough discount, so many things can go wrong with the company that you now own a part of. And you can still, you're not necessarily going to make money, but you're still going to be in the game, right? If you do proper value investing, you get to keep playing. And value investing is really a long-term game. And the key there with Buffett's rule number 1, don't lose money. If we don't lose money, or if at least we don't lose much money on any given investment opportunity, we can continue playing. All right? So that's a very important principle. And then the third one, Mr. Market is prone to emotional and erratic behavior. We've seen that quite a bit in 2020. The key is to look at Mr. Market not as, a wise, communicator of what assets are worth at any given time, but as the emotional, kind of schizophrenic entity that we get to use as our servant, right? We don't need to look at Mr. Market as our master. And it's really easy to fall into that camp of looking at the market as, having all this wisdom. And, if the price goes down, that means we were wrong. It's easy to jump to that conclusion very quickly. But it's much better, it's much more profitable as an investor to look at Mr. Market as, someone who's a little bit batty, a little bit crazy once in a while. And to just wait that out, right? Trust that we've valued the company properly and that over time, the market will come to agree with the valuation work that we've done. Really at the heart of value investing is this bargain idea, right? Margin of safety, bargains. You want to really get what you pay for, right? We want to get more than we pay for, ideally. Value investing, as properly practiced, constitutes a tiny, small minority of all investment professionals. This is something that's easy for me to forget because I've really been steeped in the value investing tradition, value investing principles for so long that it's easy to think this is what most people are doing. But in reality, and every time I look at what Robinhood investors are doing, what Webull investors are doing, it's a reminder like, oh yeah, what I'm doing with value investing is the minority. Most people are playing by entirely different rules, and I'm going to touch on what those are. So, how most investors play the game of investing. A stock is first and foremost a piece of paper that can be traded all the time, at any time, right? And therefore, successful investing lies in the successful guessing of stock price movements. Whew, that's a tough game. That's a tough game, guys. The market is to be respected and even feared because it dictates whether you win or lose the game. That is also a scary proposition, right? So it's really, a lot of people they're playing the short-term game. They're playing the short-term price swing game, which is really stressful. I'd much prefer to play my game where it's like, all right, I want to own this company for 3, 5, 10 years, rather than get in and out of positions every month. That's a lot, that'd be a lot harder for me to sleep at night if I was playing that game. True value investors, as properly practiced, that's the key there, as properly practiced. A lot of people call themselves value investors, but they're not actually adhering to value investment principles. True value investors have consistently outperformed the market, right? This is the investors of Graham and Doddsville. All of the, a lot of the value investors in Dataroma that we follow. They've been practicing these principles of value investing laid down by Benjamin Graham and Warren Buffett. Whereas just about all the other strategies either matched the market or severely underperformed the market over a long period of time. Okay, so it's one of the few tried and true ways to outperform the market, to do better than the market, which is great for our compound growth engines. I mean, the interest rate that we're compounding our money at, it is such a big factor, right? Such a big factor. If we don't have to settle for that 8 to 10% of an index fund like the S&P 500, it is well worth some extra effort to do better than that. If value investing works so well, why don't more people do it, right? Well, it turns out it has a lot to do with human psychology. You must have a frame of mind that if you do your work correctly and the market goes against you, you should be comfortable standing alone. This is very difficult for people. Another word for it is being a contrarian. It's really hard. It's really hard to be the only one, to feel like you're the only one who's holding a particular investment view, where everyone else is riding, these high flyers, right? And seemingly getting rich in a very short period of time. It's very difficult to act against that, even if it's the right thing to do over the long run, the more profitable thing to do. This is a very difficult and unnatural thing to do, right? Most people see you as stupid and self-delusional. It is, it is very difficult to take a contrary position when everyone else is looking at you like, what are you smoking, man? Clearly that's not going to work. Nobody else thinks it's going to work. You need to get your head checked. Our very evolution required a certain level of conformity, right? When we would go out, we would hunt as groups because that was the safe thing to do. If you went out on your own to hunt or do something because you didn't agree with what the group was doing, that puts you in a compromised position. That's a dangerous position to be in. At least it used to be back in hunter-gatherer times. So it's that conformity is really programmed into our DNA. We're here because, to an extent, we followed that. We stayed together as a group. We didn't dissent too much. So it's really deep. It takes mutated genes. I like this. It takes mutated genes to stand alone when everyone else disagrees with you, right? So you get these value investors that are mutants. They're taking these contrary positions, acting against, millions of years of DNA. So Li Lu is a mutant. That's what I got from that. And I'm working hard to become a mutant, oddly enough. Free markets work very well with goods and services, okay, free markets, but less so with financial assets. I thought this was interesting. Financial assets, at their essence, are a discounting mechanism to predict the future. Discounted estimated cash earnings into infinity, right? That's how we come up with the value of a business. We're trying to predict the earnings from now until Judgment Day and discount those back to what those future cash flows are worth today. There's a necessary element of speculation or guessing when you're valuing financial assets. We don't know what the future holds, so we have to guess. So there's already that built-in element of speculation. This guessing or speculation can become exaggerated in the stock market. And it's easy to see why that might be. You've got predictions. That's really what stock market values are based on, predictions of the future. And then you've got herd mentality. You've got all of these psychological biases that are acting on people, making guesses about the future. So it's not hard to extrapolate that a little bit and see why there's these wild price fluctuations. We can stack the odds in our favor by betting infrequently, right? This is, Pabrai, Buffett, Li Lu. They don't buy new positions very often. Maybe once a year, even once every couple of years. For Pabrai and Li Lu, I think that's probably right. And only when there is a large margin of safety. Most people do not have the mental discipline to do this. It is very difficult to wait for a fat pitch, right? To wait for an obvious opportunity to come along. When, everybody's getting rich buying Tesla and Apple and Microsoft, and it is very difficult to have the discipline to wait for the obvious investment decision. The most interesting thing we can do as value investors is find an enduring, earning-generating franchise. So this is talking about a compounding machine, finding long-term compounders. If you can combine cheap price, right, combine margin of safety, buying something for less than it's worth, with high quality, which is the ability to consistently generate cash earnings on a compounded, growing basis. That's the holy grail. That's cheap, and that's great business. Cheap business, great business. And those don't happen very often, which makes sense, right? Those do not happen very often. And that's really what Mohnish Pabrai is getting more focused on finding, is these 5 to 10x long-term compounders. So he doesn't have to get in and out of positions every couple of years, because that's a lot of work. That's a lot of work to do. So here's something interesting. He says, if I were starting all over again, Li Lu is basically giving advice to the students at San Francisco State University. If I were you starting all over again, I would first study all the great examples in the past in which markets went to the extreme in some small segment of securities that give you a tremendous margin of safety. So he's, studying the dislocations of the past. okay? Extremes where price versus value were, 90% away, something like that. All sorts of things can happen and you'll still come out okay, right? If you buy something with that big of a margin of safety, the vast majority of outcomes, you're going to end out ahead. You're going to end up ahead. That's really what we're looking for. Study those examples and then study what is available today. There are always opportunities like this in any market. As long as humans remain the same, which he suspects will be true after millions of years of being the same, right? Humans don't change very fast. Even with all of the technology, we still have all the same biases. We make emotional decisions. Humans aren't going to change very quickly at all. So as long as humans remain the same, these opportunities will exist, right? So you don't have to worry too much about, even though we have all of this technology, it's become a lot easier to find potentially undervalued stocks. But there's always corners of the market, right? There's areas where not very many people are looking. I made a video the last 2 days about spin-offs. Spin-offs seem like, back in the 90s and 80s when Greenblatt was really making heyday on spin-offs. It seems like it's a little bit more competitive these days, because probably one big reason is because of Joel Greenblatt's book. You Can Be a Stock Market Genius, that really alerted people to the opportunities in that corner of the market. But there's always other corners of the market to look. So if you guys know any, please let me know in the comments. And then he was asked 2 questions that I want to kind of touch on here real quick. How do you decide when to sell? I think that's a fantastic question, because it's a lot harder to know when to sell than to know when to buy. So he gives kind of 2 answers to this. If the source of the value is the asset value, right? The current assets, you want to reevaluate your upside and downside every once in a while, right? Just to make sure if the thing is overvalued at some point, and you're just buying based on asset value, you're not buying based on the value of future earnings, it might be time to get out. So you have to monitor how the situation changes over time. The second answer he gave, if the source of value is earnings, he tends to be in less of a hurry to sell, right? Those are potentially the long-term compounders. He also says every time you sell stock, you take out 30 to 40% interest-free borrow, right? Because you don't have to pay the capital gains tax on that, right? You kind of kick that can down the road and use that you would have to pay to kind of prime your compound growth engine. By not selling, you avoid paying capital gains taxes. As long as you hold your borrowing from the government on an interest-free and risk-free basis. And I think this is something that's underappreciated with investors. Why, it can be a lot more advantageous to take the approach of trying to identify these long-term compounders, having the patience to wait until they get into your buy zone, rather than buying 50-cent dollars every year or 2, like Monish Pabrai kind of started out doing, and I think Phil Town as well. A lot of investors, Buffett, buying cigarette butts. If it goes to extremely overvalued, in the case where you're buying because you're buying for future earnings, if it goes extremely overvalued, or if the business environment changes, then you may want to change your course of action, right? Another point, one of the keys to success for a long-term investor is that you have to endure long periods of time in which you do nothing, right? And you're not just sitting on your thumb, right? You're studying all the time, but you're not buying, right? You're not investing into new opportunities. You're doing that very infrequently, because it's rare when obvious opportunities present themselves. It does not happen all that often. that something that I'm capable of understanding comes at me with a 50% margin of safety or something like that. That's also a long-term compounder. So that's a big point. And then the last question here that he was asked that I want to talk about: what role does diversification play in constructing your portfolio? And I haven't heard Pabrai or some of these other super investors I follow talk about this point very much. So it was interesting to me. He says you always have to have some kind of diversification, right? You can't just own one stock, right? That's not prudent. And the reason you have to have some kind of diversification, A, you could be wrong, right? You could be wrong about that investment. There might be something you're not seeing. And B, even if you're right, you're betting on statistics, right? The future is a distribution of all probabilities. So let's say you identify an investment opportunity and you calculate that 90% of the time you're going to make money on that bet, but 10% you're not going to make money. Well, it's possible that the time that you invest in it is going to fall into that 10% camp and you're actually going to lose money, even though the odds were stacked in your favor on that particular investment. That's why we need to have more than one, certainly, more than one investment. Right? You don't want that 10% outcome to knock you out of the game. Because, I mean, again, Buffett's rule number one, don't lose money. The whole reason for that rule number one, we need to stay in the game. If we're going to, get rich on a compound growth engine, we will get rich if we can keep that compound growth engine going. But if we, use leverage, or if we do something where we lose all our money or even go into the negative, we're out of the game. There's no more compound growth engine. So we need to stay in the game, okay? Because compound growth is really my interest, the returns I'm making, going back into my investment, and then my returns, my next year's returns are on top of that principal and the returns, right? So it's really the returns that kind of stack on top of each other. And if I'm losing money, it just disrupts that whole engine. So that just doesn't work. On the other hand, it's extremely rare to find. So at first he's saying you need more than one, right? You need to diversify to an extent. On the other hand, it's extremely rare to find no-brainer great opportunities, right? Like I was talking about. You have to wait a long time for that fat pitch to come. When that finally happens, you certainly don't want to diversify away from the opportunity that you've been patiently waiting for just to buy some other inferior opportunities so that you can feel like you're diversified, right? So investment, it's really all about opportunity cost. You've got to weigh what your great opportunities are, what your confidence is, what your conviction is, and what else you can do with your money. I think the biggest key here for Li Lu, you got to find a few very good opportunities where you have high conviction. You've got to weigh, not having all of your eggs in one basket, but also having enough money in your high conviction ideas that those really move the needle on your portfolio. So it's a balancing act between those two things. So that's it, guys. Definitely, if you're interested in going a little bit deeper, actually I think I went pretty deep, but I'm going to be watching more Li Lu lectures probably in the next couple of weeks. I'll do more videos like this. Let me know if you're interested in that. It seems like there's a lot of people interested in Li Lu. Charlie Munger, he has his personal wealth in basically 3 different places: Berkshire, Costco, and with Li Lu, right? So clearly Li Lu is a fantastic investor. It takes a lot for somebody like Charlie Munger to trust someone else with their money. Charlie thinks can do even better than him. So Li Lu is a fantastic investor. If you want to see what he's holding now, you can look at, I think he's in Data Roma. But if he's not, you can just search Himalaya Capital in SEC. You can find his latest 13F to see what he owns. I believe he owns Bank of America, Micron, Facebook, and Google. Facebook and Google were very recent additions to Li Lu's portfolio, so I thought that was interesting. Anyway, guys, that's all I got. Li Lu, awesome. Definitely dive into his stuff whenever you get the opportunity. All right, I will leave it at that and see you guys in the next video. Take care.